Hi, Dominique, and welcome again to another week of key events in the week ahead. Hope you're doing well.
Hi, Andrew. It's nice to see you. You look all summery and relaxed.
Thank you. Thanks very much. So let's just start off with, I guess could be kind of perceived as maybe one of the weeks, probably more positive for, I guess, for markets and probably lower perceptions around inflation. And, you know, what's your interpretation of this thing, and how do you think the markets react to that, as we kind of usually like to go through, and what do you see from here?
Cool. So, markets tend to be very analytical. They like to count every tree in the forest rather than look at the big picture. They are also very short-term focused. So, I mean, with this, you can already guess that I don't agree with the views that inflation has peaked and the Fed is about to pivot. In fact, and I would say to all the Fed speakers, including a very dovish person like Charlie Evans from the Chicago Fed, all said, we're sticking to the knitting of the June SCP. There will be more hikes and more hikes next year as well. So, I mean, I think, we had better than expected data on inflation, but the big picture has not changed. I think what is going on is that in terms of goods price inflation, obviously it's improvement in supply chains, but also we have inventories liquidation. Like I was reading in the Wall Street Journal that now is the best time in 10 years to buy a bicycle. If you want a high-end bicycle with, all kinds of bells and whistles, titanium, maybe not titanium, but it's cheap because it was misordered, basically. So part of what we are seeing in terms of lower goods inflation is a one-off base. And also keep in mind that with the improvement in supply chains, there is much less of a need to build up inventory, just in case you don't get delivered on time. So I think there was that. On the services side, I mean, again, look at the big picture. The month-on-month data tends to be very noisy. And the big picture is that, whoa, I mean, look at wages. They are close to 6-7% year on year, and they are likely to accelerate because what typically happens with wages is that they lag prices. So like most people would have a compensation discussion only once a year. But what happens when inflation goes up is that workers ask to renegotiate their salaries more often. And with businesses so desperate to hire because workers are so cheap, real wages have been coming down. They are, of course, very willing to listen. And I think, I would say, in terms of wage price inflation, the best is yet to come. So,
can I ask quick, what's the? I just always feel like I get confused a little bit. Maybe some of our clients, investors. What's the best data points you look for to assess wage growth?
So there are two. There is one called the Economic Cost Employment Cost Index, ECI, which is a Fed preferred measure and which adjusts wages for changes in the composition of labor, of employment. So this one is quarterly, but there is another one which has been around for less time than the ECI, and perhaps is less well known for that reason. It's called the Atlanta Fed Median Wage Tracker, which is also trying to adjust.
I was looking at something like that earlier today, where which has been, I guess, the longer term or the stickier parts of it have been continuing to go higher.
Oh, so that's the sticky price. Yeah. So but back to wages. The ECI and the Atlanta Fed data are fairly consistent. We are talking 6-7%. And I think the big acceleration is yet to come. And keep something in, there's something all our listeners need to really keep in mind, which is the explosion of strikes and unionization, how unions are making gains. And that's because workers are getting some of their bargaining power back. They lost it a long time ago, maybe with the Volcker recession of the 1980s. But now, because the Fed and Congress have pumped up the economy in such an extreme manner, there is a huge pent-up demand. And workers are, they got cash from the government and they are a little reluctant to go back to work. I mean, why would you go back to work for, low wage if you are doing something that doesn't interest you? Or something that you're not passionate about, or, who wants to be a cash register person or even a barista, Yes. So the bottom line is, I fear the explosion in wages is still to come. And the one thing that really caught my eyes this week in terms of the data is the economic surprise index. It jumped up. And I'm wondering, I've been of the camp that the technical recession we had is just that, technical. It's an air pocket, not a crash in terms of growth.
That consistently. Yep.
Yeah. And I'm wondering if what we're not seeing is the beginning of a rebound in growth, which frankly would be quite catastrophic for the Fed, because they need growth to slow down, for wages to slow down, and so on and so forth.
Yeah, I mean, I think the market's idea that employment can continue to be strong, growth can start picking up, and inflation is just magically going to completely come down to 3-4% or lower, seems a difficult thing to kind of all accept. And obviously some of the short term is supply chain bottlenecks are probably becoming unstuck, and we agree with that. But the issue about wages particularly isn't really changing. And I think it was like Zoltan, whatever, somebody else was commenting as well that, Volcker, for everything he did, he also had in raising rates to kind of drop, cause a recession. He also had an administration that was aggressive in reducing the power of unions. For example, I think he was noting the firing of the air traffic controllers.
Yeah.
And you have an administration currently, at least in the US, which is very different, and in some cases supporting the unions. So that together, which I think does make some sense. I guess the question is, so what is the fallout? The other thing, while I was away, which makes a lot of sense, is that we've seen a massive increase in liquidity conditions, positive liquidity conditions as well, especially with equities rallying, credit rallying, and the inversion in the U.S. yield curve. Like, all this together, agree, this doesn't seem to make sense. So again, I guess it goes back to the question that I probably ask like most weeks: what is the ideal trade then? Is the yield curve inversion really? I mean, I think the Fed is trying to tell the markets, we are going to continue to move. And I think this seems like the more important meeting, one of the more important meetings, or maybe the most important meeting had this year. If they continue to go 75, despite what this week as an example, that the markets are assuming that inflation is coming down, that seems pretty important to me. But so what's your interpretation on that?
Oh, so my preferred trade definitely the deep inversion, and I'm going to write on
Right.
this.
So you still think probably 2-year, paying 2-year yields in the US is probably the best part of the curve, and that's the best trade.
Sure, but if you want RV trade, I like the inversion, and I think what the reason also I like the inversion is that, you know, it very clearly shows one of my favorite themes, which is that it's going to be much tougher for the Fed to tighten than they or anyone else is currently
Okay.
anticipating.
Okay.
And the reason is that the 10-year is a benchmark for a lot of lending, like the 30-year mortgage, for instance,
Of course.
is closer to the 10-year. Well, was closer to the 10-year because of prepayment. So track the 10-year more closely than the 30-year, but maybe that's going to change because the prepayments are dying down, obviously. Mortgages rates where they are. But the 10-year is really the linchpin for the transmission of monetary tightening to the real economy. And so if the 10-year goes down, as you've just explained, you know, in general, if financial conditions ease, monetary tightening doesn't get translated.
Mortgage rates and mortgage yields have been coming down. Despite the Fed raising rates. I mean, at least in the last whatever 2 months or something.
No, totally. And this is going to be a huge issue. You know, what can they do? In terms, I think we've discussed QT and selling bonds. The problem is that if they sell bonds, they will have to book capital losses because QE/QT is basically an investment scheme for buying high and selling low, right? I mean, you buy the bonds when.
But this part I don't understand. Sorry, this part I don't understand is, to me, it seems like we take, which I agree with everything you were saying. To me, it seems that ideally for the Fed, is the whole curve would be at like 3.5% right now, not an inversion. And then it would almost kind of do a lot more of the work than they need to do. So why wouldn't they more aggressively sell longer dated bonds? Like, to me, a massive curve inversion just makes their job harder. Or is that incorrect?
100%. But there are a couple of things going on there. So first of all, QT is new, and QT starts from their starting point, because they bought an enormous quantity of bonds. It's new. They are a little afraid of what it might do to markets. Then you have someone like Kansas City Fed President George, who thinks that QT is very powerful, and she's afraid of what stronger QT might do to the economy. And then, well, though she's one person on the committee, and I believe she's retiring next year, but she's one voice. But you know, there could be others. And the other issue, which is a political economy issue, is about. Before I get to the issue of outright sales, I could raise the cap on the bonds, on the treasury. Yes. Right. And this is my expectation. I give them a couple of months.
They could also more aggressively reduce their holdings of mortgages specifically.
But they can't, because the problem is that between now and the next 5 years, there are only 2 billion of MBS that are maturing. And then when you have rates that high, mortgage rates that high in historical terms, no one is going to prepay. So they are stuck. The only way to shrink the MBS portfolio is to proceed with outright sales. But then, given that interest rates are higher than when they bought, which is, by the way, a structural problem with QE and QT, because you do QE when rates are zero, so when bonds are very expensive, and you do QT when the Fed funds rate is off the zero bound, so bonds are very cheap. So in effect, QE/QT is a buy high, sell low scheme. So it means you're going to make capital losses when you implement the scheme. In technical terms, there is no reason why you cannot operate a central bank with negative equity, but there are lots of policy implications. So the Fed won't like being compared to an emerging market central bank, that's for sure. Then if they go to Congress and ask for a recap, Congress is not happy, especially the Republicans, with the Fed performance. So this is going to cost them. So Republicans have been talking about some reforms of the Fed, which to me make perfect sense and are long overdue. But the Fed, like any very conservative bureaucracies, won't like it either. And then the Fed would be asking recap money while it is paying hundreds of billions to banks and to money market funds, by the way, through the RRP facility in interest.
Right.
And that, I mean, remember the political backdrop in the US is that of very strong populism. So I can see the populists from the right and from the left ganging up on the Fed. So for all these reasons,
because interest rates are going higher and they're storing some of their excess reserves overnight at the Fed as opposed to on other banks' balance sheets.
So there is that issue as well, that before the crisis, the Fed, the Treasury used to keep its money at banks rather than at the Fed. And they could do that.
Yes.
So remember, if the Treasury doesn't get, the Treasury in the past would get transfers from the Fed. So, either they get paid through interest on the TGA or through the transfers. Yeah. But the bottom line is that this should be a purely technical issue. But because of the dysfunctional politics of the US, I think it could be a very serious impediment to monetary policy implementation.
Yeah, and I'm sure whichever party is not in power, or especially as Democrats own the presidency, Republicans will blame the Fed and associate the Fed with Democrats and say, they've helped cause this problem. Now they're taking massive losses, obviously not understanding that the policies they've done have tried to kind of support in both directions the US economy, but they'll just say there's billions of dollars of losses instead of going into your pocket. We're paying these bureaucrats that the administration has appointed or something like that. So.
Oh, as you know, I think crisis of governance at the Fed is coming. I mean, if my view on inflation is correct, and my view on the Fed funds rate is correct, and if the Fed announces an 8% terminal rate, it will have to show unemployment at 5-6%, probably higher. So it will have to announce that it's deliberately engineering a recession to bring down inflation, something Volcker never had to do. Yeah. And I think that makes the task of the Fed now much harder than Volcker. So whether this can be done, without a change of governance at the Fed is an open question. But it's not.
Sorry, I was going to ask one question is, I had read recently somewhere that the next step that's going to, the Fed and what's priced in the market is not consistent right now. So surprisingly, considering kind of actions of the last 5 years.
It's not surprising. I'll tell you why it's not surprising. And if I could go back quickly to the issue of the curve is flattening too soon. Because the Fed has been in denial. They've been talking about soft landing. So the markets have deducted they'll blanch at the first sign of unemployment.
So you think the Fed is in many ways created this?
Exactly.
Yeah.
I think there is another issue, which is that there is a structural change in the relationship between bond yields and nominal GDP. The spread between the two is now zero when it was like in a normal time about 1% or so, something I intend to write about, which is one of the other reasons why the curve is inverting. But I think it's also the Fed's own creation, because unlike the Bank of England, the Fed has not been able to tell markets, look, we have really tough times ahead. And so the market, knowing that actually, if you want to bring down inflation, you really need to slow the economy, deducting that the Fed doesn't have the stomach to do it. And so this will make the Fed task even harder.
So if anything, you're a market participant and you're looking at the data the last couple of weeks and you say, well, growth is okay or even stronger. And so all this talk of a crazy recession is wrong. And then inflation's coming down. So this kind of looks like a soft landing. So the Fed was right all along that they can handle this, as opposed to we mostly agree that it's very difficult and almost pretty much impossible to do what they're talking about doing. So the thing I was going to ask you is, and then we'll move on to kind of the week ahead, which is, I had read somewhere people saying the next step is what the Fed's going to say is, and partly because of the situation, a lot of Western governments have a large amount of debt anyway, and if they can have significant, decently negative real rates, they can kind of work down that debt as well. And so the next step is the idea of going back to 2%, at least like next year inflation. That's not our goal anymore. Our goal is to bring inflation down to a consistent 4 to 5%. We believe in today's world of economic security, reshoring, wartime footing, energy transformation, that the 2% inflation goal, or target is no longer viable, and a 4 to 5%. And I'm reading that, I'm thinking that makes a lot of sense to me. And I haven't heard that yet. Maybe you've heard it, but what do you think of that?
So I think it's a political economy question. I tend not to agree because, where do central bankers derive their sense of self-worth? Not from money. They are definitely not paid like their private sector counterpart, but from status. And I think that, if Fed representatives showed up at global meetings, the IMF annual meetings, the BIS central bankers meeting with a 4 to 5% inflation, there would be some little smiles from their counterparts and a loss of status. So, and also this would go against economic orthodoxy. So I can see a sort of discomfort there, psychological discomfort. And then the other counter argument to this view is the politics. I mean, can you imagine if inflation doesn't come down? I mean, in the last Humphrey Hawkins testimony, the senators, the GOP senators told Chair Powell, do you realize that if inflation does not come down, you will be the person accountable? So given the state of politics, I don't think this is viable. And also the issue with, I think economically it's not viable either, because typically when inflation has been in that range, it's moved up, it's not moved down. And for a very simple reason, is that once inflation gets close to about 4 or 5%, it starts impacting behavior. We start having the wage price spiral, which we are having now. And I can't believe people are not seeing it. All you need to do is to plot nominal wages against nominal inflation. And it's there, and it's really going to be tough to get rid of it. But I think, you start getting these changes in behavior around 4 or 5%. So it is definitely a risk. On balance, I don't think it's likely for the reasons I've explained, but definitely something to keep an eye on.
Okay, sorry, last question before, I'm just enjoying this discussion so much, and hopefully listeners are as well. Let's say in the next 4 to 6 weeks, what could change the market's view, do you think? Is it a piece of data? Is it something else? Is Humphrey Hawkins, I don't want to just concentrate on that, but is that going to change? Because what's interesting is that you're saying, most people normally are saying, well, the Fed's saying one thing and the market's ignoring it. But you're saying is the Fed is kind of talking out of both sides of its mouth. When they were said, soft landing, but we're still going to, the market here is soft landing. So they're not really talking only one way. So, yeah, so in the next 4 to 6 weeks, do you see that? Or clearly this could continue for next 2 to 3 weeks or 4 weeks. And in the next 1 to 2, 3 years, it's just a blip on the screen. It doesn't mean anything.
So I'm more of the blip side in the sense that, yes, the Fed is talking from both sides of its mouth. We have Jackson Hole coming up in 2 weeks, and I'm prepared to bet chocolate of good quality chocolate that we're going to have a speech by Chair Powell, which says, we will conquer inflation. And by the way, it will be painless. So, and also this is summer, everybody's away. We all feel in a very, very relaxed mood, having a great time, going to the beach. Not much, I think there is more scope for markets to move higher. I think, the sort of tougher times comes after Labor Day. And once we've had a couple of inflation prints that, surprise, surprise, show inflation has not been vanquished yet. So I think we could have another good 4 6 weeks ahead. And this is the bottom. I mean, to me, the most plausible scenario is that this marvelous idea that you can painlessly reduce inflation, it gets destroyed by bad inflation data in the fall.
Yeah. Okay, cool. All right, on that, for the next kind of 5 to 7 days, yeah, what are you looking for? Yeah.
So we get retail sales, and I have a hunch the market is a little too pessimistic here. The consumer confidence is rebounding. Growth is rebounding, the labor market is strong, and inflation has come down. People have more money in their pocket because gas prices have come down, and the US consumer is like the Energizer bunny. The consumer will keep consuming long after we are dead. So, there is a scope for a positive surprise. So that's one key data point. Even though, of course, the substitution between goods and services, especially non-durable goods, is still going on. So you have that. Then you have
retail sales is goods and services.
Retail sales is goods plus restaurants.
Okay, fine.
Yeah. So restaurants, weather is so nice. I think restaurants will do extremely well. So we could see a little surprise here. Right. Then, we have a couple of Fed manufacturing surveys and industrial production. And there the market expects an improvement, which is my view too. I mean, I think what this week is going to tell us with greater certainty is whether growth is rebounding. And I'm betting it is, but, you know, I hope our readers will follow my comments on Bloomberg. We shall see. So
and generally, stronger growth in this environment probably means the whole curve moves up about in tandem.
Yeah, I mean, or even more disinversion. What's not to like? You know, the Fed, markets believe the Fed is about to dovish pivot and growth. I mean, wow, this is
Does that actually mean the curve is less inverted, I would think?
agreed. Agreed. Then, you know, there are a couple of data points that are interesting. One is housing market. And there is something quite extraordinary going on with the housing market, actually, which is a disconnect between prices and sales. Sales have been going down since Q2 2021, but prices are still up there in the stratosphere. And again, something I will write about, but there is something really interesting here, which is listings have collapsed. So because households have strong balance sheet, because interest rates are still negative,
mortgage rates have actually come down a little bit recently.
Yeah. So what they are doing is they are not listing, which is basically the supply is adjusting very fast. And also housing is a smaller share of their total assets than before the GFC. So because it's really paradoxical, but because of the strong balance sheet of household balance sheet, what we have is super high real estate prices, while real estate investment, I mean residential investment, is falling. It's normalizing, it's falling. And for the Fed, again, that is not really great news because residential investment is very small. It's about 3.5% of GDP. So a contraction is not moving the needle in terms of overall GDP growth. On the other hand, in terms of long-term OER and rents inflation, you know, stratospheric real estate inflation means that rents are not going to come down anytime soon, or that you will need a recession to bring down wages and bring down rents. So it's really fascinating. It's a completely new thing. During the GFC, you could really see sales and house prices moving in sync. And that synchronicity has completely broken down, basically because the Fed, with their crazy easing, gave people the opportunity of buying houses at, you know, very, very low rates. So you had this amazing increase of prices.
Tell people in your homeborn country, where people were getting 50 basis points mortgages and 80% LTV.
Well, that's it. So, and again, it speaks to the theme of it will be much tougher for the Fed to tighten policy because they eased so much. They built a lot of imbalances in the economy, and there is nowhere on earth they can bring us back to 2% inflation without some recession. So I'm looking for that. The other thing that I think I've mentioned it, but I'd like to mention it again because it's really important. Claims. We've had a steady increase in initial claim, but a much smaller increase in continuing claim. And continuing claims, of course, is initial claims plus minus the people who found job and are no longer needing to get unemployment insurance.
Thank you very much for listening. And as always, I mean, I have to say this is probably one of the best week aheads that we've done, really kind of diving deep into Dominique's view on the market, the disconnect between what the Fed claims they're saying and what the market's interpreting. So hope you've enjoyed it.